Alright, are you an independent IT contractor earning around $180,000 per year? If so, then I know you're probably paying a ton of taxes. If I tell you almost half of your earnings are going to taxes, I'm sure you're going to want to hear some tax tips to try to help you save in taxes. So, the first thing to think about when it comes to minimizing your taxes is establishing whether you're earning personal services income. Personal services income, or PSI, is income produced principally from an individual's personal skills, expertise, and labor. IT consultants usually fall into this category because you're not making money from the sale of goods, but rather than the sale of the personal service. If you're earning PSI, I've got you covered. Just check out my PSI video that explains everything you need to know, including how to reduce your taxes by up to 19%. Now, if you're not earning PSI, the best way to minimize your taxes is by starting a company. It's quite common for people to structure their professional affairs by setting up an entity to run their business. The tax rate for small companies is just 25%, which is far better than with the personal tax rate of up to 45%. Companies can also claim a wider range of tax deductions and usually gets government grants. You can't just set up a company purely for tax minimization reasons because the ATO may think that's some kind of tax avoidance scheme, and that's a web you do not want to get tangled in. Basically, if you set up the company to retain a personal services income within the company to pay less tax, you'll be alienating your PSI. The ATO doesn't want this because it means you pay a lower tax rate and have access to a range of deductions that wouldn't be available to an individual providing the same services as an employee. So you'll need to have a legitimate reason for setting up a company, or you'll attract the general anti-avoidance rules. These rules essentially would deny you those tax benefits that come with operating a company. If you're operating a personal services business through a company and you're not income splitting and profits aren't retained in the company, then the anti-avoidance rules won't apply. There are also many other reasons why people set up companies, such as asset protection, succession planning, building a business, and business growth. For example, I set up an accounting practice, Box Advisory Services, as a company to protect my personal assets and because the company branding is often more appealing to clients and stakeholders. So if you can prove that you've set up a company for reasons other than just a tax benefit, then the general anti-avoidance rules shouldn't apply to you. Another entity you could set up would be a discretionary trust structure, which will allow you to distribute funds to beneficiaries of the trust. But this is quite a complex strategy and there are a ton of other rules you need to abide by, so it's best to chat to an accountant about this. Okay, so now that we have tax tip number 1 out of the way, let's get on to the juicy stuff, tax deductions. My second tax tip would be able to make sure that you claim all the available tax deductions for your business. So the ATO allows you to claim your contractor business expenses against your assessable income to reduce your tax liability. Any income you make from carrying on your business is assessable income for tax purposes. There are also 2 types of tax deductions. You can claim operating expenses and capital expenses. Operating expenses are things like your wages, rent, and can be claimed in your financial year you incurred it. Capital expenses are for machinery and equipment that are usually claimed over a longer period of time. So, unfortunately, you can't claim a tax deduction for your entertainment expenses, traffic fines, or personal or domestic expenses. There are generally 3 simple rules that the ATO uses to determine whether your tax deduction claim is valid. Number 1, the expense must have been for the purpose of your business rather than for personal use. Number 2, if the expense was split between personal use and business use, you could only claim the business use portion. And number 3, you must hold on to all the records to prove the expense was for business. For example, if you buy a car only for business use, you can claim a deduction on the full purchase of the car. But if you're using it for personal use and business use, you can only claim the business use portion for your business. So if the car is used 70% of the time for the business, then you can only claim 70% of that as a tax deduction. If you're a sole trader, you can claim all your business tax deductions on your individual tax return. But if you're operating through your business like a company or trust structure, you'll claim your tax deductions on your company tax return and your trust tax return. Here's a quick list of tax IT consultants can claim: car expenses, self-education expenses, computers, software, office expenses, wages, contractors and consultants, marketing, advertising, your website costs, telephone costs, and your legal and accounting fees. Another tax tip, especially if you're operating a company, would be to establish the tax implications for how you draw money out of your business. Drawing a salary or wage or a director's fee is the most simple and common method of taking money out of a limited company. The company essentially becomes the employer and then you are the employee. The payments will be tax deductible for the company and the payment will be included in the director's income tax return for the financial year, meaning the director will be paying the tax on his salary or wage, not the company. Another way of taking the money out of a limited company is through an expense reimbursement for directors. So if the director has paid for the expenses on behalf of the company in the course of exclusively running the business, then the company can repay these amounts without attracting any additional taxes. There are two other methods, including dividend payments and director's loans. If you want to learn more about each method, make sure to check out another video I filmed on this topic. Beyond these few tax tips, if you're going to be setting up a company for your IT business, you will need to get yourself sorted with insurances, including public liability insurance, professional indemnity insurance, and maybe even workers' comp. Small businesses in every industry face risks every single day, especially if they're standing out. There's always going to be unforeseen events that happen that you can't plan for. I mean, look what happened in 2020. Anything can just change in a split second, and it could be devastating consequences if you're not protected. So anyway guys, those are just a few tips from me. Setting up a company or a trust and distributing profits can reduce your taxes, protecting your assets, assist you in growth and succession planning. But you need to be careful with the general anti-avoidance rules around PSI. Also, make sure you're drawing money in the most tax-effective way and don't forget about insurance. If you're looking for some tax tips on how to get started with setting up your company, yes, you've guessed it. I have a YouTube video for that too. Make sure to check it out. Otherwise, if you have any questions, make sure to drop them in the comments below or book a free consultation with the Box Advisory team. I left the link in the description below. That's it from me. See you guys next time.